Good morning and welcome to our 10 minutes at 10 today. We're going to be finding the profit in your profit and loss account. So what is a profit and loss account? Fundamentally, it is the income less expenses equals your profit. It covers a period of time, so it could be a month, could be a week, could be quarterly, could be annually. So where is the profit in your business? Your profit and loss account should find your profit and loss for that time period, whether it be your month, your quarter, or your annual accounts. You should be able to see, if you structure your P&L properly, your profit and loss of your products, perhaps of your services, and if you're super careful, you might be able to find your profit and loss of your customers. So what goes in the P&L, Harry?
Well, we mentioned earlier it is income less your expenses equals your profits, but it's actually a little bit more than that as well. What we have are our sales, we have our cost of sales, which are our variable costs, which are directly related to our relevant sales. And then we have our gross profit. Now, this is the net effect of our sales less our cost of sales. Really, really important profit line here because it gives us the idea of our margin based on our sales. So really, really key bit of information is our gross profit margin. Then we have other income. So this is income which comes from other sources. So it might not be sales, it might not be related directly to your trading activity, but it may be items such as grant income or interest income. So not directly related to a sale, but it's still income in our business.
And if you are a not-for-profit and it's a donation, it's not taxable. So it's another reason why we need to keep that separate.
Exactly. Really, really important. And then, of course, we have our overheads. You may have also heard of these referred to as fixed costs. And the reason for that is because usually these are relatively fixed. So they may be fixed costs, they may be ad hoc, they may not have a relation to your sales volume at all. Mm-hmm. So you may find you incur the same charge if you make no sales versus if you make lots of sales.
So what's an example of a fixed overhead?
So one
tend to be sort of fixed.
Well, tends to be the rent we pay on this room would be an example. The power to light it. Generally speaking, even if we say this was a sales pitch, if we made no sales, still going to charge us the same amount from the utility company. If we made hundreds of sales, still going to charge us the same amount from the utility company.
Until we move property and then it all sort of steps up a little bit. Now, an example of a less fixed or not fixed overhead might be if we have to replace the carpet in the room or if we have to paint the walls in the room. We have a repair and maintenance cost that's a one-off, but it's not a fixed cost, it's still an overhead, and it has no relation to the volume of sales that we might have.
Exactly. Then the net effect of our sales, less our cost of sales, add our other income, less our overheads, will give us our net profit or operating profit, depending whether or not you have corporation tax or any non-operating expenditure in there as well. So important lines in the P&L, well, they're all important, but gross profit, really, really important. Net profit, also really important because it gives you an idea of, if you're a limited company, how many profits you have available to distribute in terms of dividends.
Yeah, so the gross profit tells you how much profit your product or your sales are contributing to your overheads. So if, for example, you're building a widget and it costs you £50 to build that widget, then that extra £50 gross profit is your contribution to your overhead. So you need to sell X many widgets to cover your business overheads, X many more to create a profit for you. Now, if it cost you £95 to create that widget instead of £50, and all of a sudden you've only got that little £5 buffer, that £5 gross profit, and you've got to sell many, many more widgets in order to then cover your overheads and many, many more on top of that in order to make a profit. So your gross profit needs to be as small as possible. Keep an eye on that and keep an eye on the cost of selling each of the products that you're selling to make sure that you're generating more profit for your bottom line and for you.
And also, really key point in this one is you may, say you have your P&L, depending on the nature of your business, you may encounter different types of P&L. by which I mean, and actually this links in really
You're talking
well.
about the basis, aren't you?
Yeah,
So
exactly.
The basis for
the accounting basis for your P&L. So we may have a cash basis. Now, we mentioned a little bit about single entry and double entry accounting within our accounting principles. So although it's quite a dry subject, it has a really strong connection in with this, which is why we thought it would be useful to mention it in that topic. So single entry accounting is when we post transactions directly from the bank account. So there's not necessarily invoices in place. There's not any bills. You just money out,
cash in, cash
money
out.
in. Exactly. And this generates a cash basis P&L, which is most commonly used in a small business where you don't have credit terms on any of your purchases or your sales.
It might be a small business below the VAT threshold, mightn't it?
Yes. So sole traders may choose this option. It just simplifies the process down a little bit as well.
But when you get a bit bigger, you need accrual accounting.
Yep. And accrual accounting is a little bit more sophisticated, and it's for those companies which do have credit terms on their invoices and their purchases in particular, or maybe you hold stock, or maybe you're just, well, once you get to a certain size, you're going to need this anyway. But essentially, what it is your P&L will be reporting based on invoice dates. So if you've got a sales invoice, it'll be raised and you'll have an income reflected in your P&L based on the invoice date, even if the item isn't paid. So this is how accrual is slightly different to cash. So cash is based on when you physically receive the money. Yeah. Accrual is based on when you raise the invoice or when the invoice relates to in terms of a period.
So how are we going to use our profit and loss account? Well, there are many ways we can use our profit and loss. It's one of the most core reports in your business, really, really important for you. So first of all, you're going to use it to check your profit. So it's your profit per month, profit per quarter, profit per year, however, whatever time period you're measuring. Then you can use it to look at the trend across that year. So always look at the month-on-month reporting to understand whether your profits are going down, in which case you need to do something about it, or whether your profits are going up, in which case you could still take action, but to enhance that, improve that, or do more of the good things that happen in your business. So a profit and loss account will also help you understand your break-even point. So how much product or service do you need to sell in order to make your business profitable, in order to contribute to your overheads? So the break-even point is usually the first point that people start to look at when they're trying to make their business work. It's not always a good idea to focus on breaking even, because then you often forget what you need to do to make a profit. So going back to one of the modules we presented earlier in Profit First, you need to understand what you want out of the business and therefore how much you need to sell to break even. That's fine, but what we really want to know is how much you need to sell to make a profit, to make profit for you. So we're also going to use our profit and loss for tax planning. If we know what our operating profit or our trading profit is each month, we can put a rough estimation of our corporation or personal tax liabilities into our zero account, and we can track that as we go forward each month. So if you're a limited company and you're able to track your profits and calculate your estimated corporation tax, that tells you how much is left for a dividend to pay yourself. Now, it's not fixed at that point in time. It's very, very approximate, but it's a very close approximation to where you're likely to be. Your accountant will make adjustments at the end of the year for things like entertainment and depreciation costs and things that are disallowed, and will also give you the benefit of capital allowances for any assets that you may have bought. But just putting an approximate tax calculation in each month is really, really helpful and can help you make sure you've got enough tax or cash saved to make sure you can pay your tax liabilities.
Yeah, and even if it's slightly overstated,
it's even better. It's more better, cash saved,
because then at least you're prepared for it all.
Yes.
And the other thing to say with personal tax is P&L really, really vital, because remember, if you're self-employed, you pay tax based on profits generated in your company,
not on how much cash you've taken out.
Exactly. So even if you haven't drawn out the same amount of cash as you generated in profit, you're paying tax on the profits. Yeah. So really vital bit of information.
And that you can accrue in your zero account if you're clever. So what else can we use our profit and loss account for? Well, we use them to check VAT returns. So you can run a quarterly profit and loss account as a sense check to your VAT returns, just to make sure that the numbers stack up and they make sense. You can also use them for reporting to your board, to your bank, to any investors in your company, and particularly if you are fundraising, looking for a loan or looking for investment or looking for a grant, they will always ask you for an up-to-date profit and loss account and perhaps your management accounts. So super important to make sure that you have management accounts and a profit and loss in your business.
So how exactly do we then review our P&L? So we've mentioned a little bit on what goes into the P&L, what the different bases are in preparing your P&L, and of course how to use it. But how do you actually review it when it comes down to it? So firstly, I would say if you have a P&L and you have historical data especially, really good thing here is check for trends. So I would have a look at it based on a monthly basis, compare it against as many periods as you can get on screen.
Usually it's
11.
about 12, isn't it? You can get 11 prior periods in a zero account.
And that comes in really handy for the next bit, because we want to review the trends. And really, this really simple one here is basically we look for anything that looks abnormal. And one thing that does stand out as blaringly obvious to me especially is when your gross profit is negative. So we mentioned earlier your gross profit is your sales income less the costs directly related to those sales. So if it's negative,
to be consistent, wouldn't you?
Yeah, if it's negative, you'd expect it to be a little bit unusual. It can happen, but generally speaking, most people sell the product for more than it costs them. So,
and if they don't, you need to stop selling it.
Some people have loss leaders, but loss leaders only really work if you've got huge volume.
And if you've got an upsell, you've got to have
exactly.
Upsell.
If you're a smaller business, loss
if you
leaders,
had that, you wouldn't have negative gross profit because you'd it just doesn't make sense. You need to really think about loss leading products. In the long term, they often just don't make sense.
And we have seen smaller companies who do say, "Oh, that's a loss leader." Why is it a loss leader? You're a small company. You don't need a loss leader.
You can't afford it.
You just can't afford it. You're just giving away the product for nothing. It's just not going to help you.
In fact, you're paying to give the product away if it's a loss leader. And why would you do that? That's crazy.
Essentially, it just impacts your bottom line and what goes in your pocket. So it's daft. But another thing with this one is your cost of sales are usually relatively consistent, by which I mean they're proportionately in relation to your sales. So as your sales increase, we'd expect cost of sales to increase slightly as well. As they reduce, we'd expect cost of sales to reduce a little bit as well. So basically, we're looking for, if you look at it in terms of a percentage, so cost of sales as a percentage of your sales, if there's big fluctuations in the percentages month on month, that would be something that I'd say is a little bit abnormal. Perhaps the timing's not quite right. You've got sale in one month, but the cost relating to it in a previous month or a month after.
So we're looking for about 30 to 50% cost of sales, aren't we? And then 70 to 50% contribution to your profits or to you.
Yeah, but that may vary depending on whatever your business activities are.
It will. But if you're in a massively loss-making business or your profits are, 80, 85, 90%, which we have seen in some businesses, your business model just isn't working.
And that is one of the hard realities of it.
It is. Well, that you can make a conscious decision. Do you continue or do you not? And that's another core function of the P&L, is to work out when you are making a loss-making product or a loss-making business, and you can either fix it or you can't, in which case some hard decisions need to be made.
And that's vital when you're looking at break-even, because if you work out the sales you need to achieve a break-even point of ridiculously high, you risk not being able to fulfill those orders. So basically, better gross profit margin is going to really help.
So what else do you need to look for?
Another thing we need to look for in our P&L is overheads. So we basically start from the top, work your way down. That's the suggestion, I would say. Best approach. With overheads, I would say look for trends where there's big fluctuations. So generally speaking, overheads are quite smooth between months. Now, you will get the odd month where it suddenly jumps and you're aware of it. But usually, say things like rent, rates, electricity, gas, etc. A lot of them are relatively consistent. Generally, they're fairly flat in your P&L. If you've got a big peak and a big trough, it's definitely worth looking into, because you may have a lumpy invoice, by which I mean an invoice which covers more than one accounting period. So you may have an invoice which covers a quarter, and that all of a sudden makes your P&L look a little bit like, rather than doing this, it does this a lot. And it makes it much harder to predict what your profit is on a month-by-month basis.
So what else do we need to be looking for? There's 2 more things.
There is. So nils and blank items. These ones are by far the most obvious, in my opinion. So basically, reviewing your P&L, if there's any sudden, there's no invoice, you'll just show a 0 in the account. Now, there's a few reasons why this might be. It might be that 1, the invoice hasn't been received. 2, you may not have provided for a cost, even though you're expecting an invoice to come. Or 3, you might have it miscoded somewhere else in the account.
And that happens all the time. So you think you're missing something in, legal fees or bookkeeping, and it's actually gone into cost of sales. So it's inflating the wrong area of the P&L.
Yeah. And then that links back to your cost of sales, perhaps looking a little bit odd as well.
Yeah, so consistent reporting is really, really important, but so hard to get right. Quite often people, see an invoice that have come in, they forget where they posted it to last time. This looks about right. So you can set defaults in your accounting system. That will help you to make sure that you get the account postings consistently correct month on month.
Now, sometimes you may know that an item is dropping off, like an insurance contract. If that suddenly drops off, it means basically you're waiting for a renewal document, most likely. You'll be very much aware if you have no insurance in place, I'm sure. So nil items and any drop-offs, really useful. And then also, I mentioned it a little bit earlier, is any big peaks, any big troughs in your figures. So when you're reviewing trends, if you have sudden jumps in costs or sudden reductions, maybe not zeros, but sudden reductions in costs, definitely worth looking into, because some of your costs might vary more than others, such as repairs, maintenance, etc. But other costs, such as rent, you would notice very, very quickly if you suddenly had a big jump in a cost in a rent account.
So what do we need to do if the accounts don't look right? Well, there are 3 or 4 things we can do to correct them. So either if it's expected and it can be explained, we leave it. If it's an item that's missing, we find the invoice or we put a provision in for it. If it's incorrect, we correct it and we reallocate it. So these are all quick steps that we can take to fix those issues. So today we've been over finding the profit in your profit and loss account. So thank you for joining us for our 10 or not really 10 minutes at 10 o'clock today. If you're in the BBB club, then jump on in and look at today's lesson, and we'll see you tomorrow. Thank you very much for joining us. Bye.